Okay. Recording starting. Recording in progress போட்டுச்சு. Yeah. நேரம் உட்காந்து. ரெடியா? Good morning, madam. My name is Harivarman Chandran, and today I'm going to be presenting and explaining the article review chosen by. The title of this article is Does Islamic Equity Investment Provide Diversification Benefits to Conventional Investors? So there are two researchers, which are Burhan Saiti and Nazrul Hazizi Nordin. And the date of publication of the article was January 2018. The purpose of the article aims to determine if Malaysian-based investors actually benefit from diversifying into Islamic and conventional equity markets in Southeast Asia and globally. So using the multivariate CARS DCC model, it analyzes volatilities and correlations to assess the risk-adjusted returns and diversification benefits of Islamic equities, which provides insight for optimizing investment strategies and mitigating market risk. Next, for the problems. Next slide. For the problems, the objective of the study. This study aims to determine whether Islamic equity investments provide diversification benefits to conventional investors. Specifically, it focuses on Malaysian investors and examines how including Islamic equities in their portfolios could potentially enhance diversification and manage risk. So for practical significance, understanding the diversification benefits of Islamic equities is crucial for investors in Malaysia, a country with a robust Islamic finance sector. This insight is also relevant on a global scale as it helps investors manage risk and optimize return in increasingly interconnected financial markets. So third one is unique asset characteristics. Islamic equities are based on Sharia principles, which means they are different from conventional equities in terms of underlying asset structures and business activities. These differences may offer unique risk management advantages and potential for improved portfolio performance. These points succinctly capture the essence of the problem and its relevance to both local and international investors. For the review of the literature, first one is relevancy of sources, which comprehensive range of studies on Islamic equity investments. It also includes research on performance, volatility, and diversification benefits. It also addresses unique characteristics of Islamic finance. For the coverage of review, there is a well-balanced scope for Islamic finance principles and its market behavior, which includes methodologies for assessing diversification benefits. For the coverage of review, it also avoids being overly broad or narrowly focused. For the references, incorporates recent studies from the last decade, which includes seminal works for historical content. And third one is reflects both current developments and foundational theories. For the objectivity of evidences, it presents a balanced view of positive findings and limitations. It also avoids bias by acknowledging diverse research outcomes. It also enhances the credibility and the reliability of the study. Next, for the design and procedures. First one is methodology, which uses the multivariate GARS DCC model to analyze time-varying volatilities and correlations. It also captures dynamic relationship between Malaysia and international equity indices. For the originality, there is empirical and quantitative, applying GARS DCC to a new data. It also provides new evidence on diversification benefits of Islamic equities for Malaysian investors. So for the procedures, there are a few procedures. First one is data collection, which daily closing prices from June 29, 2007 and to June 30, 2016. So for the analysis, it estimates volatilities and correlation using the GARS DCC model. So for the interpretation, it assesses risk reductions and performance enhancement from including Islamic equities. For the variables and sampling, there are two, independent and dependent. Independent variables is returns of Islamic and conventional equity indices, where dependent variable is returns of the Malaysian stock index. And the sampling period was from June 29, 2007 until June 30, 2016 with data from reliable financial sources. Next is data analysis and presentation. So for the data analyzed, the daily closing prices of selected equity indices was from June 29, 2007 until June 30, 2016. And we also analyzed the calculation of daily returns for each index, use of multivariate GARS DCC model, and estimation of time-varying volatilities and correlations. We also analyzed the focus on Malaysia stock index and other selected equity indices. For the data quantitative and qualitative, quantitative data is daily closing prices and returns and equity indices from Southeast Asia and major international markets. And there was no qualitative data used. For the hypothesis and purpose, hypothesis is Islamic equity investments offer significant diversification benefits to conventional investors. The purpose was to examine the diversification benefits for Malaysia equity investors by including both conventional and Islamic equity markets. And the findings was Islamic indices generally less volatile, and Japanese MSCI indices and USA MSCI indices provide substantial diversification benefits. So next is data analysis and presentation. For the weakness discussed, there are a few, which reliance on historical data. We believe it may not capture future market dynamics or evolving nature of Islamic finance. The second one is sample period and selected indices. Results may not be generalizable to other time periods or markets. Third one is assumption of multivariate GARS DCC model. We believe there is limitations in handling extreme market events or structural breaks. The last one is defining and measuring Islamic equities. We may have challenges due to varying interpretations of the Sharia compliance. And for the future recommendations, we suggest explore longer time periods and incorporate a broader range of indices and consider alternative econometric models to get a more reliable uh, result, and to investigate specific characteristics of Islamic equities, such as sectoral composition, adherence to Sharia principles. For the conclusion and implications, there are a few recommendations. For the investors, the recommendation is to diversify portfolios by including Islamic equities, especially from the USA and Japan. For the fund managers and financial advisors, the recommendation is to educate clients about the potential advantage of Islamic investments to enhance their portfolio performance. For the policymakers is to create supportive environments that facilitate the growth of Islamic finance and encourage its integration into mainstream financial market. For the result affected, Malaysia-based equity investors and fund managers, the empirical evidence support the benefits of incorporating Islamic equities into their investment strategies. For the policymakers and financial regulators, the findings can be used to promote the development of Islamic financial markets and actually attract more investors to invest in. For the financial institutions offering Islamic products, the results can be leveraged to market Islamic investment product more effectively. For the implication, the enhanced risk-adjusted returns, which is inclusion of Islamic equities, can actually improve the portfolio performance. And the second one is reduce overall portfolio risk, which will be diversifying with Islamic equities and lower risk. And the last one is growing importance of Islamic finance, which we believe Islamic equities should be considered in the diversified portfolios, especially in the markets with a strong Islamic presence like Malaysia. That's all from me. Thank you.